Welcome, everybody, and thank you for attending our optimization deep dive today, a joint session between MSCI and Refinitiv. Before we begin, I'd like to cover a few housekeeping items. First, some technical notes. There's no dial-in number for audio, so please use your device sound and plug in your headphones to listen to the webinar. Click the media player on your screen to enable sound and video and ensure that Flash is enabled on your browser. If the slides are stuck, please refresh your browser at the bottom of your audience console screen. If you have any technical difficulties during the webcast, please click on the Help widget. It's a yellow question mark. You can expand your slide window by clicking on the Maximize icon on the top right of the window, or by dragging the bottom right corner of the slide area to expand at the top right corner of your audience. There is a Q&A box in the upper right-hand corner. Please submit your questions to the speakers in this box. One of us will try to answer as many questions as we can during the last 5 to 10 minutes of the webcast. But if a fuller answer is needed or we run out of time, it'll be answered later via email. To see additional resources, refer to the window box below the slides deck. And finally, the link to the recorded webcast, a copy of the slides, and other resources will be mailed to you after the conclusion of the event. You may also access the webcast on demand using the same audience link that you used to get into the webcast today. And right at the end of the webcast, there'll be a survey, which we'd appreciate you taking the time out. It's very short, and we do use those answers. So without further ado, my name is Dan Sinreich. I'm on the product management team here at MSCI in analytics. I'm joined today by Stephanie Greiner, who's on the portfolio management and analytics team at Refinitiv with Icon. And also by Katia Del Moro, who's on the MSCI consulting team focusing on optimization and working with large asset managers. Today's session will be on optimization, and without further ado, I will turn it over to Katia to walk you first through some concepts around the optimizer, and then after Katia speaks, we'll turn it over to Stephanie, who'll give some practical examples on how to enact the use cases that we talk about, how to actually drive them and use them in Icon. So over to you, Katia.
Hi, good morning. Thank you very much, Dan. Good morning. Thank you for joining the webinar. To start talking about optimization today, I want to talk first about one of the theoretical foundations in modern portfolio theory, which is the efficient frontier. The efficient frontier is the set of portfolios that satisfy the condition that no other portfolio will have a higher expected return with the same level of risk. So in the area of portfolio construction, investors would like to identify this set of efficient portfolios given the universe of assets in which they can invest. And in the case of, for example, having a risk budget also, they would like to know which is the best combination of assets that they can choose. Another use case, for example, would be if the investors have a particular view on expected returns or on alphas in their assets, and they want to enhance the risk-adjusted returns in their portfolio. So this is going to be the basis, and now we're going to see how we can find these portfolios using our Barra optimizer. Another concept that we want to clarify today is the difference between total risk and tracking error. And to show you an example of which is this difference is that I want to talk about these two examples that I have on the screen. In both graphs, the blue line is the MSCI USA minimum volatility index, which we're going to consider our managed portfolio. So what is tracking error? We understand tracking error as a standard deviation of the difference in the returns of my portfolio and the benchmark. So on the left graph, the blue line is going to be the managed portfolio, the MSCI Min Vol Index, and the yellow line is going to be the benchmark. In this case, we're selecting MSCI USA. So you can see that in this case, the portfolio, the managed portfolio, the mean vol index is tracking very well the MSCI USA benchmark. And in this case, we see a tracking error of 650 basis points. On the right hand, I'm using the same managed portfolio, MSCI USA mean vol, but in this case, I'm using as a benchmark the MSCI USA growth index. So in this case, because of the kind of benchmark that I'm selecting, so I expect that my portfolio is not going to track very well this benchmark, and I would expect to have a higher active risk. And you can also look at that in the graph, that even at the end of the period that we are graphing, you can see how the correlation of these two portfolios, these two indexes, is even starting to get a bit negative. So in this case, the tracking error that we have here is 862 bips. So this is important to consider when you are optimizing your portfolio, to make sure what you are optimizing. If you are optimizing the total risk or the tracking error, because, for example, maybe you are optimizing the same portfolio, but you are selecting a different benchmark. So you may have, for example, very risky benchmark, and you are trying to minimize your tracking error against that benchmark. So you're going to come up with a very risky portfolio as well. You're going to have a small tracking error because your portfolio is tracking very well this risky index, but your portfolio itself is going to be risky. So now moving to the topic of optimization. As you might remember from our previous sessions, the optimization process, you will require different inputs. So you're going to require an initial portfolio that you want to rebalance, or maybe a cash portfolio that you want to find which are the assets that you want to invest in. You need to select benchmark and a trading universe. The benchmark here, in the case that you are working with active risk, you're going to use this benchmark to calculate, to estimate this active risk or forecasted tracking error, because our optimizer, that's what is working with forecast. So it's testing the tracking error of your portfolio. But you can also use the benchmark as a reference portfolio in case that you are optimizing the total risk of the portfolio. You are not working in active space, but maybe you want to work on constraints relative to a portfolio, to a benchmark. So maybe you want to constrain on weights relative to a benchmark, active weights relative to the benchmark holdings, etc. You will also need a factor model for the risk forecasts that you are going to use, and we're going to use Barra factor models. And expected returns, asset characteristics that you want to include in your optimization, and any additional constraint that you want to implement in your investment. At the end of running the optimization, our engine is going to give you the holdings in your optimal portfolio and the trade list that you will need to implement. So let's make a pause here to make a quick poll, and we want to know if you are currently using any portfolio optimization tool in your investment process. And if you do, how do you use it? Do you use it for portfolio construction, right? If you want to select which assets in particular you want to hold and with which weights in your investment. If you use it for asset allocation, maybe how much you want to use on fixed income, how much you want to invest on any other type of investment. The third option is no, but I'm planning to start using it in the nearest future, and you want to learn how to use it. Or fourth, you haven't been interested and you don't have any kind of rebalance through optimization in your process. So we're going to wait about 20 seconds so you can select your answer. Okay, so let's go to the next slide. Okay, so we can see the results now. It looks like it's like very equally distributed, the results, right? 27% use optimization for portfolio construction, 25% for asset allocation, and we have about 50% of the audience that are interested in learning how to use the optimizer for your investment process. Well, 23%, and some people don't use optimization right now. Okay. So moving on to our presentation. So we don't want to do this presentation very technical, but we just want to make this point here so you know what the optimizer is doing, right? So the optimizer is working with an objective fund that is intended to maximize the risk-adjusted return of your portfolio, right? So this risk-adjusted return is going to be the expected returns of the portfolio, or alphas, minus the portfolio variance. In MSCI, we believe that professional investors are better suited to estimate their own alphas, their own expected returns. So that is why the first section of this objective function, the expected returns, are going to be provided by the user. So either you estimate your own expected returns or you use any other characteristic like ESG scores or some other kind of score that you have in your process, you can use here. And in MSCI Barra, we focus on forecasting risk. So we provide our Barra factor risk models, and this is what we use in this optimizer. Just very quick reminder of what is optimization and how we are finding this optimal portfolio through optimization process, right? So optimization in general is just the process of minimizing or maximizing a function using mathematical system, right? Which can be, for example, linear programming or quadratic programming. And we define a function, and then we define a series of constraints that is going to define where our possible solutions can be found. So for example, in the case of Barra Optimizer, because we include a quadratic term in the function, which is the variance of the portfolio, our set of possible solutions is going to look something similar like the graph at the right. And I wanted to show you this graph because I want to make the point here that in a quadratic problem, you'll see that sometimes there's not going to be a unique solution. So a problem can have a global maximum and a set of local maximums. And depending on the constraints that you include in your problem and the initial portfolio, so it means the starting point that you're going to start optimizing, you may come up with one of these local maximums or with the global maximum. And this is important to consider when you start working with the optimizer, that once you run your optimization and if you don't get a result that satisfy your risk appetite, or you are not, you think that there might be another portfolio less risky, maybe it is the way that you are defining the problem, maybe it's the constraints that you are selecting, which is giving you one of these local maximums, and then you just need to continue working on changing the constraints. We want to make sure that you go through optimization as an iterative process, so you can find all these different local maximums and you can compare. So the last thing that I want to talk today in terms of theory behind the optimizer is this concept of utility and indifference curves. So the function that we are maximizing when we run the optimization, we call it the utility of the portfolio, right? Expected return minus risk. And for the optimizer, two portfolios having the same level of utility are considered identical, equivalent, right? So for a certain level of utility, you can have different portfolios which are going to have the same value, right? You can have different combinations of risk and return yielding the same value for utility. So I want to mention this because depending on the kind of constraints that you are running, it may happen that, for example, you start with two different initial portfolios, you run the same constraints, and at the end you come up with two different portfolios, two different holdings, but then you will see that they may have the same utility. That means that for the optimizer, for our algorithm, those two portfolios are identical, and then it would be up to you to decide which is the one that you want to use. But once you start working with optimization, you may start seeing these things happening, right? Like getting maybe a different set of holdings, a different trade list at the end, but then you're going to have the same utility. So I'm going to summarize quickly, which is the practical example that we're going to run today. So we're going to work on the total risk space. We want to minimize the total risk for a portfolio. We want to select assets from the MSCI World Index, and we want to compare the set of portfolios looking at different levels of ESG score. Right, so the constraints that you would put in the optimizer would be the initial portfolio. We're going to select a cash portfolio. We need to select a trading universe, which is going to be the basket of assets that the optimizer is going to use to select assets to buy from, right? So that's going to be the universe. In this case, it's going to be MSCI World Index. And we're going to select also MSCI World as a benchmark. For constraints, we don't want to have more than 5% cash in our optimal portfolio. We don't want to have trades of less than 1%. So we're starting with cash. This is going to ensure that at the end, we don't have holdings smaller than 1% in our optimal portfolio. And in terms of geek sector weights in our optimal, we don't want it to deviate more than plus or minus 20% from benchmark weights. And this is an example of what I was telling you before about how you can use this benchmark, right? So in this case, we are not minimizing the active risk of the portfolio. That means that we're not using the benchmark in the utility function, but we want to make these constraints relative to this portfolio, right? So that's why we also need to select a benchmark so you can make this this type of relative constraints. And Stephanie will show you how she's going to constrain on different levels of minimum ESG scores. So what she's going to do is, when setting a different minimum value for the ESG score that you want to have at the portfolio level, she's defining that different set of possible solutions. And the optimizer, what it's doing is finding among that set of solutions which is a portfolio that would give you the minimum risk in terms of our Barra factor models. So before going to the example and looking how to implement this in ICON, we want to make another quick poll. So for those that are already using an optimization tool in their process, how do you use it? Do you use it to reduce risk? Do you use it to reduce the tracking? Okay, give me just a second, sorry. Okay, I'm here, yeah. So do you use it to reduce risk? Do you use it to reduce tracking error? Do you overlay a tilt strategy? Do you use it to maximize the return of your portfolio? And there's also the option of, I don't currently use the optimization tools. So we're also going to to wait around 20 seconds so we can see your answers. Okay, let's stop and let's go to see the answers. Okay, so yes, we have around 40% that not currently using optimization tools. And most of the people who are using optimization tools are using it to reduce risk. That's around 20%, and 12% from the audience are using it to reduce the tracking error, and a very minority for tilting the strategy. Well, so that's all that I have for today. I have finished with the theoretical background of optimization, and now Stephanie will show you how you can implement this in Icon.
Okay, thank you very much, Katya. So let me now take you through an example from Icon. And what I'm using in Icon, as Katya mentioned, is the MSCI Bar Optimizer, utilizing the bar risk models fully embedded into Icon. So Katya outlined very nicely what this optimization problem is doing, but I'll take you through how you actually set that up in the optimizer within Icon. So starting here, I have the opportunity to choose the portfolio that I am looking to optimize. In this case, I've chosen a cash portfolio. So all that exists in this portfolio right now is US dollar, a cash position. So I set up my portfolio. And then again, as Katya alluded to before, in this particular problem, we are minimizing total risk. We could also minimize tracking error, but in this particular case, we're going to choose to minimize the total risk. Moving on, we're going to choose our trade universe. As we said, I'm going to choose the MSCI World as the trade universe. Very easy to change that if you are, doing iterations of your optimizer. But here we'll choose the MSCI World as the trade universe. So just to review, we're using cash as a portfolio. Our optimization goal is to minimize total risk, and the trade universe is the MSCI World. Now, from here, what I need to do is put in the various constraints that I want the optimizer to work toward or around. So the first thing I'm going to do is I've just added total risk to, this is going to allow me to see what is the total risk of the result. So I can actually see that on the report when the optimizer provides its results. So I'll add total risk to the report from these hours. Then I'm going to choose, I'm going to put in a constraint for the number of positions. I put in a minimum of 50. I don't want a highly concentrated portfolio, although obviously this is fairly concentrated portfolio, but I don't want to go any lower than 50 securities. And there's an option here. You can see you can set these constraints to soft. I've not done that. I really do want to make this more of a hard constraint. I don't want the optimizer, if possible, to go below 50 holdings. Next, I put in a minimum trade percent, as Katya outlined earlier, of 1%. That's to avoid this teeny tiny trade amounts in my results. So I put in a minimum trade of 1%. Next, the cash position weight. I don't want cash more than 5%. I do want to invest most of the cash that I have in equity assets. And then sector weights. So here is where the benchmark comes in. I've also I've used the MSCI World as the benchmark, and here I've put in some minimum and maximum constraints on the weightings of the final result in each sector. And the reason I do this is you'll see later. I am putting a tilt on an ESG score, and ESG scores. Obviously, there are some sectors that do much better in terms of ESG than others. And so it would be kind of the natural result for if you're tilting toward a higher ESG score, just to leave out or not invest in sectors that tend to have lower ESG scores. But most asset managers don't have the leeway to do that. Their mandate requires them to have exposure across the sectors of the benchmark that they're mandated against. So here, that's why I've put in, I've allowed a little deviation, but here I've said the minimum sector weight should be 8% of the benchmark weight. So it can go, 0.8% of the benchmark weight, so go 20% under. And the maximum weight should be the benchmark weight times 1.2 or 20% over. And that way I know I'm getting exposure to each sector, which I want. I will allow the optimizer to deviate the weights across those sectors, again, to the extent of positive or minus 20%. And then you can see I can be very specific and set this constraint to specific economic sectors. I've just chosen to set it to all 12 of the GICS economic sectors. I could choose, take some out if I wanted to. But again, I want that exposure to all of the sectors. So I'm going to put this constraint to all of the 12 GICS sectors. So here you can see now it is set to apply to all 12 GICS sectors, minimum of 0.8% of the benchmark weight, maximum of 1.2 of the benchmark weight. And then finally, as I said earlier, I'm going to add ESG score. We have an abundance of attributes, company information that you can utilize within the optimizer. In this particular case, we've chosen ESG. And so I'm going to now add some constraints or targets toward an ESG score of the resultant portfolio. So the first one I'll put in, I'm going to start a minimum of 70. That's a combined score. I'll go into a little bit of detail of that. So that's a combined score. I'm asking the optimizer to target a combined score, ESG score of 70. That's from 1 to 100. That's a score that goes from 1 to 100. And just to give you a little bit of background, that combined ESG score comes from over 178 measures across 10 categories within environmental, governance, and social. And this is a Refinitiv ESG database that these scores come from. Just to give also kind of a relative, this is the MSCI World, and the ESG score of the MSCI World Index at the index level is a little over 67. So remember, my first target is to achieve an ESG score of 70. Just to give you a relative view, the MSCI World has a score of just above 67. So my first target is to go a little bit higher than what the MSCI World is. So again, I have total risk that I'm minimizing for. I have my number of positions in at 50, minimum trade percent, cash position weight, the sector weights, plus or minus 20%, and the ESG score. So now I run that, and here is my first result. Again, targeting an ESG score of 70, I see that the total risk in this case is 16.85. The optimizer does hold now 50 assets, so it hit that constraint of minimum positions of 50. And the ESG score for this constructed portfolio is 70. And then you can see also all of the sector weights that it hit here. So that's the first optimization that I'll run. And then, of course, I can look and see a trade list. I can see the resultant assets that it bought and the amounts that it bought them in, if I want to do that. I can also then, if I'm satisfied with that, I can save that off as a portfolio and then have it available to do any other analysis that you might want to do within Icon. But let's assume I want to keep kind of iterating here. So now I'm going to change my ESG score target from 70 to 75, and I want to see what happens. And so you see the risk now is a bit above 19. I still have 50 positions. It did hit a target portfolio ESG combined score of 75. So again, and you'll see all of these results on one slide when I'm through. Again, I can see the trade list of every asset that was bought. In this case, the only sell is cash, because that's what the portfolio started out with. So now you're gonna see the pattern. I'm gonna continue to iterate here, and I want to see where my risk goes as I increase the target of a higher ESG score. So now I'll put the target at 80, and again I'll see the results, and you can see the risk number does, not surprising, go up. I still have 50 securities. Now the risk is a bit below 22%, but I have a portfolio combined ESG score of 80, which is what I targeted the optimizer to bring back. Next, I'm going to put in an ESG score of 85. So I'll keep going. And again, the risk goes up a bit more now, a bit over 26. I still have 50 assets, but I have an ESG score. Indeed, it hit 85. And then finally, I'm going to push this to 90, because I just like to see what happens across a spectrum of targets. So if I put it to 90, now what I have to do when I run that optimization scenario, effectively the optimizer cannot give me a solution that hits an ESG score of 90 with 50 securities. There just aren't enough securities with an ESG score that will give me that level. And so what I have to do is I have to set the number of positions. I'll still target 50, but I have to make it a soft constraint. I had to allow the optimizer to go a little bit lower in this particular ESG target. So I set the number of positions constraint to soft rather than hard, and then reran it. And again, you see the risk ratchets up quite significantly, over 37. I don't have 50 securities, I have 49. So the optimizer just couldn't find enough securities, couldn't find 50 securities that get me to the target ESG what I wanted. But with 49, obviously it's overweighting something that has perhaps a better score. So it does indeed hit the 90 target. So now let's just kind of lay this out, all of the results, more in a more readable format. So as I went from ESG 70, incrementally increasing it by 5 to 90, you see what happened to the total risk. Went from 16.8 to 19.6 to 22, et cetera, et cetera. And you see from 85 to 90, there starts to become a very big and drastic rise in the total risk. The number of positions, and then here I've just set out like how for each increase of target of ESG score of 5 points out of 100, the incremental risk from 70 to 75 was 2.74. This is just the delta. So to what Katya was saying earlier, with optimization, there's no right answer. Now it's up to the manager to either continue to iterate, maybe want to change other constraints, or kind of make a decision as to where the trade-off between ESG and total risk is where you want to be. Perhaps that might be something around 80, where you do have 50 securities. Your risk isn't drastically increased from the ESG scores that are more similar to what the benchmark looks like. But again, that's not a right or wrong answer. But this is the iterative nature of the optimizer. So that is how we wanted to kind of show in practice how some of these examples work. And again, instead of using ESG score, don't have to use any tilt. We could just completely focus on minimizing total risk, or I could tilt against a growth measure, some sort of value measure. I mean, it's endless as to how many constraints and targets you can put in the optimizer. So now we have a final poll question that we would like everybody to take a second to answer. What types of optimization would you be interested in exploring in future webinars? Minimizing the number of assets in a portfolio, constructing tilted portfolios, kind of what you just saw, a little bit deeper into that, constructing ESG themed portfolios, how best to work around excluding assets or sectors, or finally fixed income optimization. So I'll just stay on this poll slide for about 10 seconds or so everybody has an opportunity to answer. Okay, I'm going to push forward so we see the results. Interesting. Okay, fixed income optimization. Interesting, and minimizing number of assets. Okay, that's quite helpful. Excellent. So let me now, Dan, I'm going to turn it back over to you for Q&A. So we obviously still have Katya and Dan on the line. We also have on the line available for Q&A questions is John DeVito. John is the lead product manager for Refinitive's portfolio analytics products. So Dan, I'll turn it back over to you.
Sure. Yeah. Thanks, Stephanie. Great. Yeah, I see. I had some questions come across during the webinar, and I've answered them to all. So please do take a look at those. Some of those actually really good questions from a couple of folks. So thank you for that. So do take a look at those. I see. Let's see. There's a few more that have come in. So which I didn't get to. So let me take the first one, which I can take, and then there's one for Katya, and I think one for maybe Stephanie. The first one is, how is it calculating the total risk? Is it based on standard deviation, correlation among securities, or a combination of factors? Yes, the total risk is based on the exposure of assets to each factor, and the correlation between those factors, the covariance between those factors in our covariance matrix, and taking into account those covariances. So yeah, the total risk is based on the factor model, and then each asset's exposure to the factors in that factor model. Okay, so that's the first one. Related to that, here's an interesting one. Maybe this one's for you, Katya. Is using return covariance is the only way to optimize? Can we have a better cost function, let's say, in case of options where pay is nonlinear? I think the general question is, so if you can comment on optimization in nonlinear instruments, how does that work, and are there different ways to optimize nonlinear, really portfolios and assets with nonlinear return profiles?
Yeah, thank you, Dan. So our optimizer works with our factories model, and what we do in MSCI is that we take into account those nonlinearities in instruments in our exposures, right? So at the end, our factor model is going to capture that, and if we're talking about riskier assets, the exposures are going to reflect that. And the exposures are going to reflect which kind of instrument we are working. If we are working with some kind of derivative and it has like an underlier equity or fixed income instrument, we have our factor model is called multi-asset class. It's an integrated model that will give you exposures for all kinds of securities, right? Fixed income equities, derivatives. We even have private equity, real estate, etc. So all that kind of behavior in those instruments is going to be reflected in the exposures, and then with the covariance matrix that we have at Barra, is going to show you the higher risk if that is the case.
Yeah, thanks, Katya. Yeah, that's an important point to underscore. The exposure to a factor is nonlinear. It's based on a pricing model, and all pricing. Well, if they're good, if they're well built, the pricing models are not linear, obviously. So thank you. That's great, Katya. Oh, so one more thing I wanted to add. Also, the factor returns, right? So you build a covariance matrix based on the factor returns. Well, the factor returns are also based on nonlinear price changes. So they look at how price changes have happened in the past, and we build. It's a bit of a. I'm oversimplifying it, but those nonlinear returns are used to build up the factor returns, by which we then look at the covariance between the factors. And I do want to emphasize on this point, I put it in my answer, stress testing is very important, right? Especially if you have a nonlinear strategy. And we did a deep dive on stress testing in Icon three weeks ago, and that's certainly available. So please let us know please take a look at that and let us know if you're more interested. Okay, let me get to a couple more questions here. Okay, let's see. Is ESG one of the objective in the optimization in practice due to heterogeneity between agencies? Thank you. I didn't quite understand, but I would say ESG is a constraint in the optimization. So the optimizer, what it does, it says, look, I'm going to find the maximum return for the minimum risk, or if you don't give a return, I'm going to find the minimum risk portfolio, but given this constraint. So it's part of the objective function, but there's no but. It's part of the objective function as a constraint in the optimization. I don't know if Stephanie or Katya, if you want to add anything else to that.
No, I think that's right. That's right, Dan.
Okay.
And
great.
again, it could be ESG, it could be a growth measure, it could be many things that you can add.
Yep, exactly. It could be, that's exactly right. Yeah, we often see people tilting and wanting a certain exposure to momentum or a certain exposure to growth, things like that, maintaining with certain constraints around sectors, around countries. It gets infinite at some point, but yeah, exactly. All those are available. Okay, here's one. This one I think maybe for Stephanie. How about introducing expected returns and proceeding to full optimization? Stephanie, do you want to comment on introducing expected returns into the optimization in Icon?
Yeah, so there is an opportunity. I didn't do it in the example, but there is an opportunity where you can absolutely introduce, I think as Katya said earlier, your own calculated expected returns, or if you get them elsewhere, and you can certainly load those and have the optimizer utilize expected returns. I think that answers the question. Dan, do you think?
Yep. No, that's right. Thank you. Okay, here's another good question. Is the ex-ante covariance just one day forward, or is the factor model forecast for longer term? Yeah, very good question. So the model we're using with Icon specifically is is built and optimized for a roughly 6 to 12 month horizon. So when we build the covariance, now we build many different horizons. So I'll go into that in just a second. But the horizon that of the covariance matrix that we build, which is the most popular one among our whole client base, is the one that is targeted to forecast ex-ante risk over roughly 6 to 12 months. In our language, we call that a long horizon model. So 6 to 12 months, we call that long horizon. And it is generally the most popular one in the marketplace. However, we certainly build models of different horizons that are also very popular. So we build what we call a short horizon model, which really looks at roughly a 1 to 3 month stability, and forecast horizon. So that one tends to be a little more jumpy and a little more reactive than the 6 to 12 month one. We also have if you think of, so maybe that's in the middle. Then if you think of both sides, on the very long horizon, we have for certain models, we have something called extra long, which is over a year. We use a lot of historical equal weight, so that makes it a very long horizon. And then on the other opposite side, we have these trading models, which are really short, really daily forecast horizons. And the key here is to use the model that is appropriate for your strategy and for your level of turnover, depending on the horizon. So we put the long one in Icon because that is the most popular one, but certainly if there's demand, we can certainly look at building other ones as well. The key thing with all of the models that I should emphasize is that even the extra short horizon, they're not built by just looking at just each asset and the returns of each asset against each other. Those work in really short horizons, 1 to 10 days, but then you start ending up with spurious correlations unless you put some structure around the factor model. And so all of our factor models have that structure, and so we can go into it, and there are certain white papers. Just contact me to forward those to you. But but because we put a structure around the behavior and the relationship between the factors, they tend to hold that stability over the 4 horizons I mentioned. All right, so okay, that's it. Okay, let's see. How accurate are expected? Here's a question: how accurate are expected returns if we look at a portfolio 1 year later? Good question. We actually do this. We have various we call it an analytical QA, AQA results and model validation results. It's hard for me to characterize them, but without saying, except the returns are generally in line with what we forecast broadly, and we can show you how we measure that with rolling. What we call rolling back testing measures. Just please contact me offline, and I'm happy to give you an example. And there's a place on our website where we actually show these back tested results by our model validation team. So thanks for that. Let's see, what kinds of hypotheses are used for forecasting regarding the market volatility? I would say we don't really forecast the market volatility. Again, we provide we provide models that where the relationship between assets are explained in a method that holds over various volatility regimes. That's the best way I could say it. We're not a market prognosticator or forecaster, but we build models that have stable relationships, that are able to show stable relationships between factors over longer periods of time. It's really those 4 periods that I mentioned. Yeah, okay, another one. How does MSCI optimization tool perform under different market cycles? I'll take a shot. Maybe I'll let Katya answer as well. So again, it depends. What we saw especially during the COVID crisis, especially in March, April, we had a lot of clients using our short horizon models to understand what was happening in the very, very short term. But really, they continue using the longer horizon models for optimization, for building their portfolios, and for reporting. The issue is that if you can't switch. You can't all of a sudden switch the management of your portfolio from long to short, because then you end up with a lot of turnover, and then you're presenting a lot of risk measures that are short term versus long term, and the people here communicating those two will not quite understand them. But again, if you take a longer horizon view, and the optimization tool that we have with Icon uses that model, again, that relationship tends to be stable in the long horizon, Although by absolutely in the near term, if you look at what happened in March and April, it's certainly you get some very unexpected results. But then guess what? Now you're looking into June, July. Well, if you look at the volatility of the markets, those are frankly back to fairly normal right at this point. So it's really the question for you is what is your investment horizon and what is your turnover goal, right? Depending on what to figure out what model to use. Any comments on that, Katya? I don't want to.
No. So in terms of the optimizer, right? The optimizer is going to give you a result that is going to depend on the risk model that you are using, right? So if you are using, for example, our clients, right, using the long-term model, is going to have a lower turnover. So when rebalancing their portfolio, they're not going to see so many differences. During this COVID period, it was a particular case because, in general, all our models started showing higher levels of forecasted risks, which at the beginning for some clients was a bit surprising. But as weeks started to go on, we saw that it was the correct number. So the optimizer is going to react depending on which is the risk model that we're using.
Yep. Okay, let's see. Here's one, and Stephanie, maybe you can comment on this one too. It's about ESG. So the question is, academics observe high variety in ratings across the rating agencies. Are ESG ratings reliable enough to set them in the constraints? And do asset managers effectively set ESG constraints in their portfolio optimization? So I will say that the ESG ratings we used here in the demo and with Icon are not the same ones as the MSCI ratings. So I'll just make and so I can't really speak about those. I'll let Stephanie. I'll just say about ESG ratings. Look, if the ESG rating is given based on fundamental research that you can trust, it's absolutely appropriate to use it in order to tilt that portfolio. And you have to. It becomes a sort of this decision that you make, which is like if I have a client who wants a higher ESG portfolio, can I build that for that client without sacrificing return? We have many research papers and examples that show, at least with our ratings, the answer is generally yes. You don't have to necessarily sacrifice return in order to tilt higher on ESG. And look, we see among our clients many other types of measures that are used apart from ESG, many other types of measures that are used in their constraints, and some of those measures may be used, based on more or less research than ESG. So it's not like it's not like in the marketplace today, optimization and the constraints on the optimizer are only based on hard numbers that come from GAAP accounting measures, right? So you have to make that decision around how you use ESG in the optimization. But yes, we do see ESG. Certainly, we see plenty. There's numbers out there around the ESG tilted ETFs that have come out, and the money flowing into ESG tilted strategies. How many of those are using optimization? I'm not sure, but I imagine some are. Stephanie or Katya? Katya, any other comments?
Yeah, I'll just add that, it's a very good question, right? So there's, ESG content is, available many different places. As Dan said, the ESG content that I used in the optimizer, and that's available in Icon for Refinitiv, it is Refinitiv's content. We have a large team of people that collect it, research it. And the key to our ESG content, and I think to the question, is it's fully transparent. So the user has the ability to see exactly, how the score was created can see exactly the components of the score and how it was collected, the timing, etc. So I think that transparency is the key to kind of part of your question. That if you can do that, if you can see the data in a transparent way and understand how it's collected, how it's being calculated, that's helpful.
Great. Yeah, thank you, Stephanie. Okay, great. Okay, so a few more questions. This is good. Yeah, please keep them coming. Okay, so next one, a follow-up on the horizon. So we talked a lot about the horizon. So here's a question. So if you use longer-term returns as a target variable in terms of 6 to 12-month forecast, I understand daily returns are noisy, but if you are using 6 to 12 months, are the historical factors good enough statistically? Are they statistically significant? So yes, if that's are the 6 to 12-month return at that horizon, are the factors good enough? Are they statistically significant? Yes, they are. Please, again, we have a lot of research and back testing, and so it's more than just me talking. I think that the best way to answer this is to literally show you the data around why we believe, why our data empirically shows that the factors are good, are statistically significant. Please email me offline, and I'm happy to provide you that research and put you in touch with researchers who can literally walk you through the back testing we do and the measures we provide. So yes. And then, there's a question about stationarity of factors. Again, I think these are very good research type questions that are best answered by somebody in research. I can provide a high level, and I can absolutely direct you to the docs and the statistics. But just please contact me offline for more. Okay. Here's another question. Do I understand correctly that specific option positions can be used? This is Stephanie. Can we use options in the icon with the optimizer?
Yeah, and I'm going to ask John DeVito to expand a little bit on this one. That's okay.
Sure. I was just actually typing in a response on the chat. We currently, our current implementation is equity only within Icon. However, as Dan and Katya were saying, the underlying risk model that we're using supports options and other nonlinear instruments as well. So it is absolutely on our roadmap to address those and to support those instrument types.
Perfect. Thank you, John. Yep. Thank you, Stephanie. All right. Here's a question. I don't think I can answer it, but what is the standard method to forecast the long-term value premium? I don't think I can answer that. I know some people who might, so please contact me offline, and then we can get you to somebody in research, unless, again, John or Stephanie or Katya have an answer.
I think it would be better to start with research in this case.
Yeah.
Okay, I agree. All right. Can you enter technical and or sentiment factors in portfolio construction? So that's a question. Can you enter technical and or sentiment factors in portfolio construction? We do not have sentiment factors in any of our models. But we do, so let me explain. But we do have sentiment factors in a product called Factor Lab, which is not yet available on Icon. The reason we have not included those sentiment factors in our models is because we did not find that they added to a value to the model. In other words, if you look at a large number of portfolios over many different periods of time, we did not find that adding a sentiment factor to a model actually improve the risk forecast or the explanatory power, meaning how much of risk a model explains, the explanatory power of a model. However, we did find that sentiment in some cases does have explanatory power on its own. Again, contact me offline, and I'm happy to provide more details there. What else? Okay.
I would just add to that last one,
Go ahead.
Dan, that we do have a number of different star mine factors that do take into account, various, momentum indicators and things like that, that can be used as part of the optimization constraints when you're setting.
Perfect. Thank you. Yeah. Good point. That's right. The star mine fact. That's right. Okay. Good point. Okay. A couple more questions. What alternatives to Sharpe ratio are used in the MSCI tool? It's not that Sharpe ratio is an alternative. I mean, Sharpe ratio is a metric that's used. If you mean how does the optimizer balance between risk and return? Again, it's with these constraints and penalties that we talked about, like Stephanie showed ESG. John just mentioned the star mine factors; those can be used in a constraint. So I would say those are the metrics that you can use. It's not so much as an alternative to Sharpe ratio, but in the end, the optimizer tries to find maximize that objective function, which is maximize return, minimum risk subject to constraints. So I would answer the question that way. And then maybe the last question was answered by John. Can you short in the icon optimizer? Currently it's long only, but it's on the roadmap. So I think that's it. I think that we're out of time. It's the top of the hour. So let's finish the webinar. Please just stay on for one more minute to answer the questions, the survey at the end, and then we'll close it up now. Thank you, everybody, for joining and for all the questions. Thank you.
Thank you very much. That concludes the webinar. Thank you.
Thank you very much for attending.
Yep.